Watch this wick. Price pushes up, clips the old high by 4 pips. And in doing that, it takes out every stop loss sitting above it. 30 seconds later, it does this. Every trader who got stopped out there was right about direction. They still lost. That wick was not random. It was an errand. It went up there to collect something, and then it came back for the real move. By minute 12 of this video, you'll be able to look at a wick like that and tell me exactly what it was sent to collect. Before it happens, let me show you who sends it. The trading pit is dead. The shouting, the hand signals, the paper ticket's gone. The Bank for International Settlements puts the global currency market at over $7 trillion a day. And the overwhelming majority of that now moves electronically. Algorithms quoting to algorithms at speeds no human hand has ever matched. So when you click buy, you're not trading against a person. ICT, the inner circle trader methodology, calls the thing on the other side of your order the interbank price delivery algorithm. Now, you'll hear traders talk about that like it's one machine in one basement somewhere in Manhattan. It isn't. Think of it as a behavior instead. The consistent, repeatable way institutional pricing gets delivered when the desks moving it need to fill enormous orders without shoving the market against themselves. And here's the part that should make you sit up. A behavior that repeats leaves a pattern. And a pattern can be read. So here's the one thing this video does. By the end of it, you'll be able to open any chart, any pair, any time frame, and answer 2 questions. 1. Context. What state is this market in right now? And why would I take a trade at all? 2. Reference point. Where exactly do I get in? 2 questions. Every single ICT concept you have ever seen hangs off one of those 2. Quick one before we go. This is education, not financial advice, and nothing here wins every time. So I'm also going to show you where each of these setups fails. Honestly, that part matters more than the wins. Context first. Question 1. What state is this market in? The answer is always one of 4. Not 3, not 5. 4. And once you can name the state, the chart stops being noise. Watch. Price is going sideways. Tight range. Highs getting hit, lows getting hit, nothing going anywhere. Most traders look at this and think, nothing's happening, I'll come back later. Wrong. This is the most important thing on the chart. Because a desk that needs to buy 2 billion euros cannot just buy 2 billion euros. The moment they try, price runs away from them and they get a terrible fill. So instead, they sit here and they accumulate quietly, slowly, on both sides of the range. They let retail traders sell into them at the top of the range and buy from them at the bottom, and the whole time, the position is being built. This is consolidation. And every major move you have ever missed started right here. And then it goes. Fast, one-directional, big-bodied candles, barely any pullback. The kind of move that makes you feel like you're late. Because you're late. That's the point. This is expansion. The position is built, the accumulation is done, and now the desk wants the move. And this is the single most useful thing expansion does for you. It reveals intent. Everything before this was ambiguous. This is the market showing you its hand. Do not chase it. I'll show you what to do instead in about 4 minutes. And it is the opposite of what your instinct is telling you right now. Now price comes back. And this is where most retail traders panic, because it looks like the move is over. It looks like a reversal. It isn't. Look at where it stops. It comes back into the range it just created and no further. This is retracement. Direction hasn't changed. Price is going back to collect the orders it left behind when it moved too fast. Think of a delivery driver who blew past 3 houses on the street. He hasn't changed route. He's reversing to finish the deliveries. Retracement is where you get in. Almost every entry in this methodology happens here. And then there's the one that hurts. Price breaks the low. Everyone short piles in. Everyone long gets stopped out. And then it goes straight up and never looks back. This is reversal, and it is almost never gentle because a reversal needs fuel. It needs a large volume of orders sitting in a known location that it can take all at once. And here's the uncomfortable part. You know where those orders are? Because they're yours. We'll come back to that. All right, let's find out if that actually went in. For charts, 3 seconds each. Say it out loud. Consolidation, expansion, retracement, or reversal. Out loud. It works better. I'm serious. Consolidation. Reversal. Expansion. Retracement. And if you said reversal on that last one, good. That's exactly the trap, and the tool that separates them is coming up in 90 seconds. So you can read the state. That's context. Now, reference point. What do you actually get in? Each state hands you one specific tool, and they are not 4 random pairings, they're a chain. Expansion writes the evidence. Retracement delivers price back to it. Liquidity is where it's all headed. And equilibrium is the referee. Let's take them one at a time. Go back to that expansion move and look at the last down candle before price exploded upward. That one, sitting there red, right at the base of the move. That candle is where the buying happened. That is the footprint of the desk stepping in and is almost never fully filled on the first pass because they didn't get everything they wanted before price ran. That's a bullish order block. And when price retraces back down into it, that is your reference point. That's where you buy. Not at the top of the move. Not when it feels safe. Here, where it feels wrong. Bearish is the mirror, the last up candle before a hard move down. Now, where this fails, an order block is invalid the moment price closes decisively through it. Through the body, not just a wick. That's not a discount anymore. That's the market telling you the desk that was defending that level is gone. If you're still holding at that point, you're not trading a setup. You're hoping. Same expansion move. Different piece of evidence. When price moves that fast, it leaves something behind. Look at these 3 candles. The wick of the first one and the wick of the third one, they don't overlap. There's a window there. A slice of price where buying happened and almost no selling did. That's a fair value gap, a liquidity void, an inefficiency. And this is the bit that makes it usable. Price is drawn back to inefficiency. Not because the market is magic, but because the desks that missed the move need fills. And this is the only place they're going to get them at a reasonable price. So the gap acts like a magnet. Price comes back, fills it, and continues. Where it fails, a gap that gets fully filled and then keeps going was never support. It was just a gap. And gaps have a shelf life. A fair value gap from 4 months ago on the 5-minute chart is not a level. It's archaeology. Trade the fresh ones. Now the one from the opening. Answer me honestly. Where do you put your stop loss? If you're short, just above the recent high. If you're long, just below the recent low. Everybody does. It's in every textbook, and that's exactly the problem. Because thousands of traders putting stops in the same place doesn't create safety. It creates a pool. A dense, predictable, mapped concentration of orders sitting there above an obvious high, waiting to be triggered. And a stop loss is not a defensive instrument. A buy stop is a buy order. A sell stop is a sell order. So if you're a desk that needs to sell an enormous position, you need buyers. Thousands of them, all at once. Where are they? They're sitting right above that high. That's why price runs the high first and reverses second. It isn't hunting you personally. You're just standing where the fuel is. Where it fails. Sometimes a break above the highs is just a break above the highs. The difference is what happens immediately after. A raid reverses fast within a few candles. If price takes the high and then consolidates above it, that wasn't a sweep. That was a breakout, and you're now on the wrong side of it. Last one, and this one is a filter more than an entry. Take any range, any leg, any swing. Draw from the high to the low. The 50% level is equilibrium. Above it, price is expensive. Below it, price is cheap. And that gives you one rule that will save you more money than any indicator you have ever downloaded. Buy in the discount. Sell in the premium. If you find a perfect order block, beautiful structure, clean expansion, textbook setup, but it sits in the premium half and you want to buy it, you're buying at a bad price. The setup can be right and the location still be wrong. Where it fails, equilibrium is only as good as the range you measured. Pick the wrong high and the wrong low, and your 50% is meaningless. Measure the leg that caused the current move, not the one that looks prettiest. Now, remember this? Let's do it properly this time. Here, price goes sideways for 2 hours. Tight range, consolidation, orders being built. Here are the equal highs it left behind, and sitting above them, liquidity. Every stop from everyone who sold that range. Here's the move up through them. 4 pips past the high. The pool gets taken. Reversal fuel collected. And now watch what the drop leaves behind on the way down. There, a fair value gap. And there, at the very top, the order block. The last up candle before the whole thing let go. Price retraces. Straight back up into that order block. Fills the gap on the way. Reference point. And then it delivers. Down to the liquidity resting under the lows. That's the whole thing. Same candles you saw 11 minutes ago. Nothing on this chart changed. You did. So let's compress it. Consolidation leads to expansion. Expansion creates retracement. Retracement seeks efficiency. And efficiency delivers price toward liquidity. That's the loop. It runs on the monthly and it runs on the 1 minute. And it collapses into 4 steps. 1. Find consolidation. 2. Wait for expansion and mark the evidence it leaves. 3. Wait for retracement into that order block or fair value gap. 4. Target the liquidity on the other side. That's it. That's the model. Now, I know what happens next. You're going to go and try to learn all of it at once. Every concept, every model, every acronym. Don't. The traders I've seen actually get consistent didn't master 40 concepts. They mastered one. One setup, one model, one repeatable pattern, recognized on sight, executed the same way 100 times. Because here's the shift that actually matters. Your job is not to predict. Your job is to recognize. Which is why you got homework. Open a chart, any pair. Scroll back 6 months, far enough that you can't cheat. Now step forward candle by candle and name the state. Consolidation, expansion, retracement, reversal. Then find the tool that belongs to it. 20 charts. That's it. 20, and your eye starts doing it without you. Tell me how you get on, and tell me in the comments which one of the 4 states you find hardest to call. I read them, and whichever one wins is getting its own video. If this made the chart quieter, subscribe, because next week we're taking that liquidity sweep and turning it into an actual entry model with entry, stop, and target. See you there.